welcome everybody. I'm joined by Prashant Tripathi, the CFO of Max Life, and Jatin Khanna, who handles our investor relations and M&A activities. I'll talk about the key highlights first, and then move on to the more strategic items and our priorities going forward. I'm very happy to share that Max Financial had a robust growth in revenues of about 12% to 9,667 crores. Consolidated PBT was, however, down 35% year on year, but that's because of the unusual situation we were in last year when we were in the midst of a merger. Max Life's individual adjusted sales has grown at a strong 18% to 1,876 crores, with undiluted focus on traditional and protection products. This is with a strong focus on digital, the e-commerce channel, and which has grown about 116%. And online ULIP has been launched to gain further market share in the online market. Protection sales grew 52% year on year, resulting in a 100 basis point improvement in protection mix from 3.7% in the 9-month period of 17 to 4.7% in 18. Gross written premium grew a strong 12% to 7,852 crores. 11% growth in renewal premiums to 5,214 crores, which was led by a record improvement in the conservation ratio to 90.4%, which is probably one of the highest in the industry. Trends in expense ratios and conservation and persistency all continue to show a healthy year-on-year improvement. Claim settlement ratio is at over 96%, and it's best in class. Solvency surplus at 1,956 crores results in a ratio of 280%. Assets under management has for the first time crossed 50,000 crores, which is a milestone as at December 17. And this is now at 50,333 crores, with a growth of 23% year on year. Let me now talk about some strategic priorities for our business that we've identified in the just concluded review of the business. We will continue our efforts of deeply integrating with our partners and build capabilities across products, marketing, and technology. We will accelerate investment in proprietary channels to build a robust multi-distribution architecture. Max Life agency channel is one of the few channels in the country that is delivering positive margins. Our focus will be to build on that by growing our active agents and not just by number of agents. We will continue to build on our marketing leadership in online sales because of consistent pricing advantage powered by strong underwriting capabilities. Through fresh investments in our proprietary channels, we will aspire to grow these channels by around 35% CAGR over the next 3 years to get to a more balanced channel mix and to get close to a 40-40-20 ratio between the channels, that is, proprietary channels, access, and the others. In other words, proprietary channels would be 40, access would be 40, and the other channels would be 20. We will continue to maintain an aggressive posture towards inorganic growth for acquiring bank-based life insurers and acquiring new banker relationships, and to this effect, Max Financial Board has recently approved a significant capital raise of up to 5,000 crores. There will be a focus to pursue a more balanced product portfolio with a bias towards preferred segments in which we want to grow. Given our increased focus on affluent customer segment, you will see proportion of PAR will reduce to around 40%, with contribution from ULIP increasing to around 40%, protection focus sharpening further with contribution increasing to 8% from current 5%, and non-PAR contributing the residual 12%. We will further accelerate digitization across insurance value chain to improve customer experience and cost efficiencies. You would recall in our last call that we were aspiring to get to a 20-20-20 performance by 2020. I'm pleased to share that we deliver to the above outcomes, and if there are no regulatory headwinds, we are now aspiring to get to a 25-25-25 on sales, margins, and EV growth. So to sum up, Max Financial Services is delivering strong performance for shareholders via Max Life, which will further refine as Max Life delivers on the new strategic plan. We spoke about our vision of 20-20-20, which now improves to 25-25-25, and that's our aspiration. And so, on that note, I would like to hand it over to the moderator and open the floor for question and answers, please. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin with the question-answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. A reminder to all the participants in the conference, if you wish to ask a question, please press star and 1 at this time. We take the first question from the line of Manish Otswal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity. My question on the NBFP margin in 9M FY18 versus FY19, what is that data, sir? Because it is not available in the presentation.
Yeah, I will take that question, Mohit. Actually, we don't disclose the 9 months margin, so our disclosures are only twice every year. The first disclosure was made at the end of first half, which was after September, where we had projected that on a full year estimate of expenses, we should come close to 20. We continue to maintain that outlook for the time being, and we will disclose the numbers only at the end of the full year.
Okay. And the second question on the capital raise, we are now raising 5,000 crores of capital. And in the press release, it is mentioned that it will be used for the inorganic growth opportunity in the life insurance company. So basically, the lion's share go for this acquisition, or how it is split in terms of incremental use of capital?
Yeah, so this is obviously it's been widely publicized that we are one of the bidders for the acquisition. So should that come through, and if we are in a position to win that mandate, a large part of that would be consumed there. But at this point in time, it's difficult to announce, what the valuations are. But that's the big number which we have sought an approval for. But right now we're going through a process of diligence, and a little premature to tell you what percentage of that would go for this acquisition if we were to get it.
Okay. And last question on this, our bank insurance tie-up with Axis Bank. It is up to 2021, I believe.
That's correct.
Yeah. So when this will be for renewal, and and equity participation by Axis Bank in the Max Life can increase, or how it is?
So for now, our arrangement with Axis Bank is that they continue till 2021, right? So again, on that one, it's a little premature to tell you exactly how it's going to play out beyond that. But suffice to say that should we reach 2021, this will be almost over 10 years of a relationship, which has really stood the test of time and has done very well for both. It's been a mutually beneficial relationship. And the teams are so well entrenched that I see no reason why, somebody will want to destabilize that.
Right. And last, have we upgraded this, our 2020 guidance to 25-25-25?
That's an aspiration.
And that is not for FY20. I think it will be more about FY21 or 22. But the aspiration, as Mohit mentioned, is to lift by 5 percentage point across all the three vectors of NBFC margin, sales, and ROEV.
By 2022?
Yes.
Okay, thank you.
Thank you. We take the next question from the line of Vishal Rampuria from HDFC Securities. Please go ahead.
Hello.
Yes, go ahead, please.
Hi, sir. So one is that if you look at the third quarter numbers, the Axis channel growth is roughly 9 to 10%. So any reason why the growth is lower compared to the other channels?
Yeah. I will take that question. Actually, what is hidden in that number is the impact of demonetization last year. So it is a very high base effect because of which you are saying maybe a more moderate growth. I think my suggestion will be let's review the numbers at the end of the full year. And anyway, historically we have observed some bit of sales seasonality with respect to Axis Bank. Generally, the bias towards doing more sales is higher in last quarter versus third quarter.
Okay. So second question to ask you on this fundraising plan. So already we are holding good amount of surplus in Max Life in terms of solvency surplus. So why we plan to raise such a big amount of money?
So like Mohit,
I think Prashant, if I was to just take that, the approval we have taken is for an up to a particular amount, but needless to say, what will be raised is what is actually required to pursue the acquisition, and that amount is only an umbrella approval, so to say.
Okay, so you're saying it's a blanket approval just yet. Okay, understood. There's one last question to ask you. How much will be your group credit within your protection business? Group credit and group term both.
Can you please repeat your question one more?
So within your protection business, within your product mix, you have got protection, right, which is 4.7%. So how much of that will be group credit and group term?
All of it is individual protection business of 4.7%. Additionally, we have 1% more of group credit life. So if you had to add all of protection business, it will be 5.7. However, historically, we have been showing only the individual protection as a measure, and that is around 4.7.
And what is our strategy, to pursue the group credit business? Because many players are growing aggressively in that segment.
Yes. So our focus is going to be a bit higher on individual business, and like Mohit mentioned, that we are looking at increasing our mix of protection business to closer to 8 to 10% in next 3 to 4 years time. So I think the biggest driver will be individual business. However, suffice it to say that we will be equally focused at credit life business. We would be looking at it more aggressively, but looking at the market outlook and some of the realities of how that market is, we will operate somewhere between 1 to 2% in about 3 years time.
Thank you so much, and all the best.
Thank you.
Thank you. We take the next question from the line of Dhaval Kada from Sundaram Mutual Fund. Please go ahead.
Yeah, hi. A couple of things. First, sir, just a suggestion. I mean, I think we were pioneers in terms of disclosure for the sector, and probably as new players have come, we have sort of not upgraded to that extent. So maybe if we could provide basic stuff like margin and EV probably on a quarterly basis, that would be more helpful. If not EV, but at least margin would be more helpful. That's one. The second thing is, sir, in terms of I understand the logic of going for the capital raise approval and things around it. But just to take a step back and highlight one point. So Axis Bank has in open mentioned that they are not satisfied with the sort of annuity based distribution model, and they have aspirations for building a life insurance franchise, and probably I've seen their name appear in the IDBI Federal deal as well. So, I mean, how do you sort of rest that sort of aspiration which the bank has with our current setup? I mean, if you could just comment your thoughts on that, that would be very helpful.
So let me take that. Now, in terms of bidding for this, it is with the knowledge of Axis Bank that we have bid for this business, and we are also aware of the fact that they had bid for the business. So it's not something which is happening in a cloak and dagger fashion. So now the outcome depends on who kind of wins it. As far as the relationship with Axis is concerned, I already mentioned to you that this has been a strong one, and it stood the test of time, and it goes all the way up to 2021. So that's something which I just want to let you all know, that the fact that we bid is with the knowledge of our partners, and probably with the blessings of our partner. In terms of the disclosures, you're talking about quarterly EVs. You know how the extent of work that is required for taking out an EV even twice a year is extensive. So to now make it quarterly is something which, we take on board, but I have my doubts whether we can do that in that frequency. But I think we are probably amongst the pioneers when it comes to, disclosures in terms of EVs and otherwise. And as far as the NBM is concerned, that's something which is taken out, half yearly. And maybe there is some scope of doing that quarterly, but I leave that to Prashant to answer it.
Yeah, sure, sir. Sure. And just, sorry, on a follow-up on the Axis Bank question, sir, would you sort of agree that, they've indicated their desire to sort of move ahead from the annuity-based business of distribution to now manufacturing? Is that something that you've also witnessed in your conversation? And if so, how have you tried to tackle that situation? Thanks.
So what you have heard and what you have read is what we have heard and what we've read. There's been nothing specific in terms of, Axis coming and telling us, now listen, we are now going to go in for manufacturing, so thank you very much. This relationship is going to terminate in another 6 months from now. We haven't had any of those sort of conversations.
Sure. Great, sir. Thanks. Many thanks.
Thank you. We take the next question from the line of Sumit Kariwala from Morgan Stanley. Please go ahead.
Hello.
Hi.
Hi. Hey, just was looking for a data point. If you could share your persistency excluding single premium.
So excluding single premium is something that should be there on our website. I think we published that.
So because for the 13th month, yes, the persistency has come down slightly to 79% versus 80.
That is possible predominantly because of the singular reason that last year we had one more extra month for due collection as mandated by the government in view of the demonetizations. That has had a marginal impact. At a structural level, there is no big reduction.
Okay. And so you're saying that last year you got one more extra month, and which is why the data looked better. And this year you didn't have that extra month because there was no grace period, and therefore that number is...
No, actually, in our par business, there's an accounting thing where, the due and unpaid business is already recorded. So last year we got one extra month, this year we didn't, so hence the difference.
Okay, and single premium you have disclosed on the website, is it? Excluding single premium?
It is, the IRDA base of reporting including single premium.
Okay, and you don't disclose excluding single premium. Sorry, the line is a bit...
There is no way to disclose. We will be quite open to disclose.
Okay, because some of the players have been disclosing this. So that's fine. And that is...
Give you the confirmation, our adjustment for single premium is negligible because we don't write significant single premium.
Okay, because if I look at the data, the share of single premium is a bit on the higher side. I guess those are some products wherein you provide top-up facility. And I was just trying to understand whether that is used when you calculate persistency. I can take this offline.
So let me confirm to you. what you see as booked as single premium is something called paid-up edition, which is a feature in the par product design, where the customers have the right to buy more sum assured, and that gets added and appears as single premium. That you will see that more in par line. That is excluded in the persistency computation.
Okay. Perfect. That's very helpful. Thank you.
Thank you.
Thank you. We take the next question from the line of Amitabh Santalia from SKS Capital. Please go ahead.
Yeah. Hi, sir. I may have missed some of the questions and answers as the line was not too audible, so pardon me if I'm repeating my questions. So my first question was regarding the merger options. Are there any merger options that we are still considering after the failed HDFC Life merger?
No, the answer to that is in the negative. There is no merger opportunities or discussions which are taking place at this point in time.
Is that ruled out for the time being, or is it potentially, are we still open to that?
Let's put it this way, that as far as Max Financial Services is concerned, or Max Life is concerned, we are not proactively looking at any merger.
Okay. And do you see any need for consolidation in the sector, though? Do you see any merit in looking at exploring mergers in the future, potentially?
The fact that we are actively pursuing an acquisition opportunity, that itself tells you that we are very keen on consolidation. But the preference is to do via acquisition route than a merger route at this stage.
And could you throw a little bit of light on what type of opportunities you're looking at in terms of acquisition, and what is the size?
I touched upon that. It should be.
I may have missed that because the call was not.
We're looking at opportunities where it's value add. We just won't be going for an opportunity where you're adding on just a book. It should actually augment our distribution capabilities.
Okay. And are there opportunities available in the space that you, are there any targets that you've identified?
There's one right now which we've all bid for, which is the IDBI Federal. So that's the one on the table right now.
Okay. And what's the likely size and outlay that we're prepared to sort of
won't be in a position to tell you that because there's a process being run. So that's something which obviously is subject to diligence and a whole lot of other things. So a little premature to be saying what that value would be.
But related question would be what, just as a refresher, what is the fundraise that you have done recently, and what are you looking to do, and what's the war chest available to you?
The fundraise is for exactly this purpose, but I won't say that all of it is for this particular opportunity. There could be more.
So just to clarify, the fund has not been raised. We've taken an in-principle approval from the board, so that to pursue this opportunity, we have to go and raise funds. We have the approval and the support from the board available to go and raise such funds. And as we get through the process, and if we emerge as a final bidder, is when the funds will be raised.
So it's really an umbrella approval, or what you call an enabling resolution, which is passed by the board.
And you would raise the funds if required, not preemptively raise the money and.
No. Why would we do that? Why would we dilute ourselves if there's no opportunity? So this is going to be need-based.
And the fundraise would be at the listed entity level, the Max Financial?
Yes, it would. Yes, it would. It would be at the listed entity.
There was also, the reason I'm asking this is because there was, if I recall correctly, there was also an announcement by the parent entity about a parallel fundraise.
So the parent entity is a listed entity. The subsidiary is not listed.
No, let me
I'm
clarify.
talking about the holding level. From at the promoter level, was there not an announcement about promoter level fundraise?
All right, you're right.
So could you throw some light on that, if that's related to this, or what is the, could you just explain and clarify the difference between the two and what the quantum for the two is, etc. And is the parent level, the promoter level fundraise to pursue other unrelated opportunities, or is it to be pumped in to do Max Financial?
Okay, so let me clarify this. You're right in terms of, there were two announcements. The first one was at the promoter level for about 2,000 crores. And that is, I think KKR's name was mentioned in that. That is nothing. It's a restructure of existing debt. And that is for ventures in the sponsor's private side of the business. It has nothing to do with what we're talking about, which is the second announcement, and that is to an enabling resolution for us to raise about 5,000 crores for inorganic opportunities in the life insurance space. So they're two separate items, unconnected with each other.
Okay, and you're saying the promoter level fundraise is essentially not a fresh raise, but a restructuring of the existing debt.
Absolutely.
So it's not really fresh money that they'll be using with recourse to their holdings in Max Financial or
No. It's a restructure of debt, and it's a very good deal. Maybe not to be discussed in this call, but it's quite innovative, probably first time in the country, and I think KKR has done a fabulous job in structuring that for us.
Okay. And just lastly, very quickly, on the Axis Bank dependency, is there any, I understand I did hear your response to the earlier question about the relationship, almost being a 10-year relationship and, not seeing any reason why that would be at risk. But at the same time, I think the street is concerned, and rightly so, about your dependency on that channel. And what steps, if any, is the management trying to take to reduce that dependency? And
so I think you may have missed the second part of my preamble, where basically I talked about how we would get to the 25 stage, and there were a whole host of initiatives which we have and are embarking upon in order to basically mitigate exactly the sort of risk which you highlighted, which at this point in time the Axis, I won't call it a risk, I see that as an opportunity, and but that dependency has come down, and going forward in terms of all these initiatives, whether it's in the proprietary channels or going after the other banker space as well as online, digital, all of that put together would reduce the dependency down to about 40% or so.
Okay, thank you very much.
Thank you.
Thank you. We take the next question from the line of Latika from SKS Capital. Please go ahead.
Thanks for the opportunity, but Amitav Santalia from SKS Capital has covered exactly the question that I was planning to, so thank you.
Thank you.
Thank you. We take the next question from the line of Mithun Soni from GC Investment. Please go ahead.
Yeah, hello, sir. I have one question with respect to if you take a long-term view, I'm talking of 3 to 5 years, and strategically, would it mean as industry-wide, a bank assurance, a partnership, a bank assurance model will, like just like an HDFC or an ICICI, having an own bank or having a partnership which is long-lasting without having to worry about what is going to be the scene after 2 or 3 years is a much better model. And if that is, or do you think that the independent model like what we have today is not to be worried about from a medium to long term? When I'm saying medium to long term, 3 to 5 years and plus perspective. Can you, your view on that, please?
Yeah. So, let's get real here. I don't think, we would be in a position to be starting a bank, and we have no such intentions. So what is the next best thing which is optimal for all? Going into proprietary channels 100%, right, would not make sense because it's going to be extremely costly, and by the time, these channels break even, it takes several years. Healthy mix would be a combination of your own channels as well as online digital, as well as getting a couple of banks. Now, we have the Axis relationship, and like we said, is there till 2021, and it's strong, and it's a win-win relationship. And, we don't believe that, we're going to be seeing that relationship getting aborted in this interim. Meanwhile, if we were to get some more banks, right, that only augments the whole distribution mix and strengthens it. We also have Yes Bank, which has done very well for us. We've got Lakshmi Vilas Bank, which is again doing very well for us. So I think the answer to this question is that yes, ideally, if we had a bank, we could sleep easy. Unfortunately, that's not the case. So in order to make the best of the situation, I think a combination of proprietary channels as well as the banker channels is something which, would be desirable at this point in time for a company like ours.
So just to understand, so when you say by FY22, you are targeting about, say, 40% coming from the banker channels, would you say that by that point in time, not any single bank would have more than 25 or 30% share of that banker pie? Is that a possibility you're looking at, or that will be still very difficult?
No. See, in this statement of mine, the 40% is what I said will come down from where we are currently on Axis Bank. Okay?
Okay.
So now I'm not building in here any additional banks which might come in. So, for example, if IDBI Federal happens, okay, I don't know how that would really play out or how this mix would change. That only time will tell. But at this point in time, if we were to look at our existing distribution arrangements and the initiatives which we've embarked upon, then that's the sort of level we would see Axis coming down to.
But sir, I agree.
Really to mitigate the over dependence which you all brought up.
But just to understand, so even once we do all this thing, will we not need to partner finally with one bank from a long-term strategic perspective? And from that perspective, does it make sense to join hands with Axis as just like what we were earlier trying to do with HDFC, maybe with Axis or another private retail bank who is looking who may not have today the strong franchisee like what HDFC or ICICI would have. Is that sort of possibility not feasible for us from a medium to long-term perspective for us?
Yeah. So I think the slant in your question is driving me towards a merger sort of an answer. And like I said, at this point in time, we are not in discussions with any so-called.
I mean to say, from the medium to long term. Well, today, maybe not next 2 years, but I'm talking of a little longer perspective. That finally, will that be the path we'll have to go, or you feel that we can finally just avoid it and be independent as we are today?
Let me chip in here. Your question is presupposing that our bank partners are walking out, which is not the case. Our partnerships are strong. Mohit spoke about a 10-year relationship with Axis. We've had a 12, 13 years relationship with Yes Bank. So, and in any partnership, it's a mutual win-win, right? I mean, if they bring something to the table, we also bring something to the table. So, I mean, for example, we are also 70% free of the fee income of Axis Bank. So I think it's a mutually beneficial partnership. So I think your question is presupposing that those partnerships are weak or they are going anywhere, which Mohit clarified in the beginning itself to say there is no reason for us to believe so at this point in time. So I would say that, we should sort of take comfort out of that.
In an ideal world, what you're suggesting, if it were to happen, it would be first prize. Okay, but in reality, to really look at, the so-called bank-led insurance companies today, there are few, and we know who those companies are. But at this point in time, there is nothing concrete which one can tell you whether 3 years from now, 5 years from now, a scenario such as what you're enumerating or what you're alluding to would really arise. And like I said, we have to be prepared, from our perspective, that we should build our capabilities in a manner which kind of optimizes shareholder value. And we also must keep in mind that getting into bed with one of these also has its downsides. What happens tomorrow if mandatory open architecture comes into play? You can't rule that out.
Correct.
So, the banks, like the ones you named, bank-owned insurance companies, all of them would have to, go back to the drawing boards to try and figure out as to what should be their distribution capabilities going forward. So it cuts both ways.
And some of the larger banks have already gone the open architecture way. So, to that extent, I don't know whether, like Mohit, what Mohit also said, if there's really a merit to be tied up with a particular bank.
Yes.
So I think the strategy we are adopting is something which, we collectively believe that it's the right one. It's also been blessed by the board. There are a lot of wise men sitting on that board. So let's see how this plays out.
Yeah. One last question, if you may allow. In our aspiration for this 25, in terms of the growth and the margins and BAB, what are the key levers from the OPEX perspective you're factoring? How much of the contribution you feel can come from the OPEX related, and how much will be coming primarily from the product mix?
So I'll take that, Mohit. I guess when you get the growth of about 25%, it has a very significant impact on the margin as well as ROEV by virtue of operating leverage. So I wouldn't quite say expense only, but maintaining expense at a level so that it doesn't grow proportional to the sales or revenue. So my sense is that it will be a combination of half and half. So for example, if we are sitting at 20% margin, I think by every 1% increase, we should get about 100 basis point increase in margins. So 20 to 23 will be out of product mix, and 2% should come out of operating leverage, which is expenses.
Perfect. Thank you very much.
Thank you. We take the next question from the line of Manish Shukla from Citigroup. Please go ahead.
Good evening, and thank you for the opportunity. First, on the planned or target or aspirational distribution mix, when you say 40 Axis and 40 proprietary, I'm assuming you would want your proprietary channels to go faster than the bank rather than bank going slow, in which case it would have implication in terms of investments in the channel and costs. How do you see that impacting the profitability and your cost going forward?
Yes, so
the proprietary is more expensive.
Yeah, I just want to highlight, exactly what Mohit has said. We reviewed and we looked at our strategic plan, Manish, and what we found was there was very little investment that we have made in our own channels in the last 10 years. It was predominantly, trying to consolidate our own channels, and we together believe that time has come for us to start to make investments. However, these investments are going to be very different from opening full-fledged agency channels. And I'll tell you then what we're trying to do. These investments will be focused more towards working on agency-like, low-cost variable channels. Market has moved on in the last few years, and now there are our own experiences as well as market experiences, and some of these investments are bearing fruits. We are going to make investments on specific segments. We are going to make investments on the direct channel that we've got. We are going to make investments on internet marketing firm kind of setup. We are going to make investment on point of sales. These are all new allowances that IRD has come up with, and we believe that by doing all this, we will be able to drive the proprietary channel sales significantly higher than third-party channel sales. And, there may be investments that we may have to make, but those investments are going to have to be monitored with a payback of or break-even on a NB basis in a maximum of 3 to 4 years. So we together believe that this is required to drive our growth, to strategically balance our channel mix, and we have approval to go ahead and do that. Will that start to show up in a very significant manner, the impact on profitability or margins, etc.? The answer to that is no. Actually, I'm not outlooking significant reduction in our margins, etc. There may be some bit of reduction in statutory profit for a particular year, but I think it will all get corrected as we move along.
All right. Next is on the product mix, and Mohit alluded to your comfort with a probably 40 PAR and 40 ULIP. Now, this is a slightly higher threshold for ULIP than what you have articulated in the past. Anything inherently changed in the market which makes you more comfortable with a higher share of ULIP? And B, what, if at all, are the margin implications likely to be for this?
I already communicated that our most desired or most optimal product mix will be 60 traditional and 40 unit links. And you'll notice that even at the end of this year, to a large extent, we have achieved it. When we finish this year, you will have noticed that our ULIP mix is closer to 40 as we finish. So we are already there. I think what we are trying to do is, keep ULIP either that level or maybe 1 or 2 percentage points here and there. We want to rebalance PAR and non-PAR because we want to drive more protection. So a bit of a share of PAR will be eaten by the non-PAR, especially in protection and some bit in non-PAR saving. We are more and more comfortable with non-PAR saving as we go along because of our hedging, as well as the interest rate hedging, which is currently on the end. So really, if you look at our product mix, 2 or 3 things. Take a bit higher bet on ULIP, line to market, which a large part has been done this year already. B, focus more on protection, and C, take a bit extra bet on non-PAR savings. All of it by reducing PAR reliance.
Okay. And the talk of proposed changes for the PAR structure, your thoughts around that and what kind of implications it might have for you?
I assume that you mean some of the
charges
that have come from the product committee around.
Exactly. Yeah, the product committee recommendation.
Most of our products, I'm very happy to share with you that our surrender scales are significantly better than most of the competition. So we believe in that principle that the surrender benefits should be.
Prashant, there is some disturbance in your line. Manish, can you hear Prashant clearly?
Is it better?
It got up. This is better, Prashant. Yeah.
Okay, Manish. So basically, I have been through that, and we did an assessment, and currently it's not quite clear how that particular thing will be implemented, but it does talk about break-even year for the departing policyholder, etc. And I'm quite sure that by the time this gets approved, after going through various approval processes, Max Life will be in a very good position to manage it, because even now, if our surrender scales are reasonably better than other people.
Okay, sure. My last question is, Mohit, the proposed acquisition or M&A, will the acquiring entity be MFS or Max Life Insurance?
It will be Max Life Insurance.
Okay, all right. Thank you.
Thank you.
Thank you. We take the next question from the line of Nischint from Kotak Securities. Please go ahead.
Yeah, hi. Just one thing on the bank assurance side. From how many branches of Axis and Yes do you currently operate?
I will request you, Nischint, to ask your next question if you could. I'm just going through my notes to come up with an answer for that.
Sure. In this particular transaction that you are doing, basically where Max Life is kind of, looking at acquiring the other insurance company, would Mitsui also contribute proportionately?
Yes, they would.
Okay, sure. Those were my questions. You can let me know, Prashant.
Yeah, I will message you if that is okay with you.
That's fine. Okay. And how many employees do you have in these, working with these branches? I think that's the second part of the question.
So, just to give you the number first, I think the total number of bank branches within Axis Bank is around 3,400. Of that, really, almost all of them are active. So, the activity levels will be closer to 98-99%. On Yes Bank, I don't have the number of branches right away in front of me, but the branch activation is closer to 75%.
Sure. And the number of employees that are deployed?
The number of employees will be closer to about between 3,500, around closer to 3,500 employees.
All the three banks put together?
All the three banks put together.
Sure, great. Thank you very much.
Thank you. We take the next question from the line of Adarsh from Nomura. Please go ahead.
Yeah, thanks for taking my question. On margins, right, on your guidance or your aspiration of 25%, I just wanted to understand when I look through the product mix persistencies with various, the top league companies, right, at least the listed bank-led insurers, your aspiration on margins is probably the highest that anybody is reporting as now. And, HDFC is closer to 22% and others are lower than, 17-18%. So I just want to understand, and when I look at your cost structure, even if you adjust for your product mix, you still would have the higher cost between all of them. So I'm just trying to think about what would you do so different that you get to a margin leadership position from still having a little higher cost structure?
Yeah. That's a very good question, Adarsh. Let me just first clarify that the 25% is an aspirational number to be achieved in time from here. We will currently be at around 20%, as you know. The reason why you see our margin number closer to 20 is predominantly because of the product mix that we run with. It is also because of a result of very smart alignment of target segments to channel to products category that we choose to sell to those target segments. And with the interplay of embedded economics of different channels, you could land up with a much inferior outcome of margin in case you don't or you're not careful about what you want to sell through which channel. Or you could land up with an optimal outcome the way we have run. So that really is a combination of target segment to channel economics to the choice of product.
Yeah.
Needless to say, the choice or the fact that we run a larger share of traditional, which is around 60%. Within that we have a good mix, and we are trying to increase the mix of protection business. Also, a reasonable mix of the interest rate guarantee design. Those are the reasons why you see our margin being superior.
Understood. And just kind of mixing this question with that the regulations around the product structures.
does PAR become, from a return perspective, a little more inferior product if you take out the surrender charges, because some amount of money being paid to guys who's persisting, maybe just coming from people who are not persisting, right? So I'm just trying to think over whether that product goes through some bit of margin compression if you see any changes in the surrender charges of PAR product per se.
Yeah, that definitely is a possibility. It completely depends on what kind of scale do you give. I mean, basically, the traditional designs are a bit different from participating designs. Especially in participating, only 10% of the surrender charges go to the shareholders. The balance actually go to the PAR fund. So the bigger impact will be the IRR on PAR fund or PAR policyholders, maturing policyholders versus the departing policyholders, and that interplay is something that is worth a debate actually, and the jury is still out in to see which way it finally settles, because there is also a benefit in the argument that somebody who has decided to stay on gets a higher benefit than somebody who leaves midway.
Yeah. Understood. No, it's just that the ability to load expenses also go down, right? So that's the only question I'm trying to understand, whether there's a implied hit to the margins as well.
Yeah, unless we really look at what scale, etc., it's very hard to predict, because it can go from very harsh to where we are today. So really very, very hard for me to predict. My early look on the basis of the product committee guidelines, which is looking at this, is my sense is that it's not going to be extremely severe, and I think anything transformational will have a big impact, because all said and done, about 70% of the market or 75% of the market in India is still traditional products. So LIC, which has between 45 to 50% of market share, still sells all of traditional. Even within the private space, my sense is that closer to about 40 to 50% of the products is traditional. So at an industry level, it is very big, and hence making transformational changes can be quite hard on or difficult for the industry, and I'm sure the regulator, whosoever is making this change, will be aware of it.
Perfect. Shan, thanks a lot for your answers. Yeah.
Thank you. We take the next question from the line of Rahul Maratha from Akash Ganga Investment. Please go ahead.
Yeah, hello. Thank you for this question. The kind of lofty valuations that we are seeing in the newspapers for this IDBI Federal Life, what is the investment rationale? Like, what are the kind of return on investment we are targeting from this deal?
Yeah, Akash, you'll appreciate that, whenever there is a deal which is under a bid situation, it's not fair to be asking a question like that, because we are not in a position to divulge anything at this time. So I'll let that question pass, please.
Okay. Yeah.
So do you have some more questions? Rahul, do you have some more questions, or are you done?
No, I'm done then.
Sure, thank you very much. We take the next question from the line of Dhaval Kala from Sundaram Mutual Fund. Please go ahead.
Yeah, just a couple of follow-ups. Firstly, on margins, I just want to understand, for the 9-month period, have we seen any benefits, if any, from the guideline change that happened in terms of commissions and remuneration paid to distributor, apart from commissions? So we had some expenses going through the operating expense line. So have we saved some, or it's neutral on margin? That was the first question. And the second question was on agency channel growth. So, I mean, I was just looking at the last 5-year data, and this is for 1H, but probably true for 9 months as well. So the CAGRs have been between 7 to 9% for us from the agency channel premium contribution. So, and I think this 9 month as well, if I'm correct, it's about 11%. So just wanted to get a sense, has the agency channel moved to a steady state, high single digit, low double digit number, and we should not expect more than 20% growth from this channel? Just some thoughts over there. Thanks.
Yeah, I will take that. On the first one, the guideline change in commission has neutral impact on our margin, so no upside, no downside. B, on your question on agency channel, I think, as I mentioned to you right up front, that for last many years we were trying to consolidate agency by taking out cost, hitting the optimal product mix, and trying to deliver, closer to about 10% growth year on year. Time has come for us now to review that strategy, and as I mentioned, we are going to make investment in agency channels and all the proprietary channels. So, my expectation is that with that investment, agency and agency-like channels will jump on to closer to about 20% growth rate for next 3 years.
Prashant, sorry, just one follow-up on the agency channel answer. Could you highlight couple of investment that you're making in this channel, just to explain us how the channel will move from 9-10% to about 20%? Just couple of initiatives that would be very helpful.
Yeah, we are going to. There are many things. I think we are going to look at a concept that where we are going to add more agency manager units within us. So, at the lowest level, without really building the facility cost, the supervisory cost, the training cost, etc., which are also very significant in case of agency, we are going to just build more hands and feet for the recruitment and sales. So that's the first one. We will have close to about 600 to 700, which is 25% additional ATMs, which we are going to add ATM units. B, we are going to focus quite a lot on internet marketing firm, insurance marketing firm, which is IMF, a new channel which was allowed 2 to 3 years ago. We have reasonable success so far. We approved the concept, so we're going to make investment there. We are also going to look at a few offices in very large cities with a different model of highly skilled direct workforce, which targets more than 10 lakhs income segment of customers, and that's something which we piloted, and we're happy with the results. So we're going to, increase that. Our own channel, which we call customer advisory team, that does about a little over 130 crores of sales. We are out looking to grow that very significantly, up to 50% CAGR for next 3 years by deploying more people and expanding. So those are some initiatives. All of them are on the basis of experience that we've gained by doing the pilot. So unlike the normal belief around agency where it takes a very long time, we are looking at initiatives which could pretty much start to pay back in 3 to 4 years' time.
Sure, thanks.
Thank you. Well, that seemed to be the last question. I now hand the floor back to the management for their closing comments.
Thank you, and thank you all the participants for taking time out of your busy schedules. So until the next earnings call, goodbye all. Thank you very much.
Thank you very much. Ladies and gentlemen, on behalf of Max Financial